$500 million in loans, that's a little bit,
Mm-hmm.
So I think see that type of production, to see these things, you're going to see more of these companies start to. I think we're going to see more leave the market space, but the ones that do means that there's going to be less options, less competitiveness. So I think where we may see some of this change is you won't have as many non-QM investors fighting over rate, if that makes sense.
Yeah.
They won't have to be as aggressive because they're going to
Correct.
have less competition.
Mm-hmm.
And
so I think that's where we
see it.
I mean, it goes for a lot of real estate agents, quite honestly, because a lot of us, we're all self-employed. We do 1099s, and we try and write stuff off. Then we don't try and write stuff off so we can qualify for a loan. And where the spread was from conventional wasn't as big. I think you think you're going to start seeing that spread expand a little bit?
I think you are, especially in this climate. The hard part where I think we're going to see a couple different pieces. I think you're going to see prepayment penalties get more aggressive in the non-QM space because you don't have prepayment penalties on the QM side, but in the non-QM, it's a very normal thing. And I think they're going to become more strict, like have more more, you want to get out of the loan, it's going to cost you more.
Gotcha.
If you want to get out in a year or less or 2 years or less. And then I also think that spread on the rate, you may see that non-QM market go a little bit higher. And right now it's a very risk, I think, with a lot of uncertainty. People are saying, hey, you know what? We made a boatload of money the last couple of years. I'd rather just sit on my cash than invest it and put this money back into these risky areas. And I think that's where we might see some of it continue to dry up. The ones that have gone under so far, it's not because they didn't do a lot of volume. They did. But it's because they weren't efficient in how they did the volume. They were ones that didn't invest in technology, but instead just threw a bunch of manpower at it, right?
Gotcha.
And the problem is that doesn't create smooth processes. And in times like with rising rate markets and this and that, like where it's gonna slow down a little bit, you got to be a little bit leaner. You got to be a little bit more streamlined, a little more efficient, so you can keep that overhead down, so you can still do production. So I think, I know that you've been in the industry. There was for a while, the implodometer, if you remember that, back in the early 2000s when the last one happened. It still exists. I didn't even know. I was laughing because we're always talking about it online, and somebody was like, hey, they're still updating this thing. And I'm like, wait, they are?
Really?
So it's still getting updated.
We got to find that. Find that.
I've got the link. I'll share it to you and send it over to you, and you can post it if you want to under this. But it's kind of interesting.
Because I think that's one of the questions that people are going to have. When a lot of people think, quote, non-QM, they think subprime. And they're thinking, oh, if these lenders are going out, are we going to end up with the same effect that we had back in 2007, 2008? Yeah. What are your thoughts on that?
I really don't think. And I think the biggest difference here is that in 2007, 2008, a lot of the loans, there wasn't much skin in the game for these subprime, for these non-QM loans. There was a lot of bars were able to shoot. They were doing loans where you can get more than 100% of the value and get money to fix up the property afterwards on a stated file. And they were balloon loans and they had all this. Now, if you want to do that, if you want to be in the non-QM space, you're putting 20% down, you're putting 30% down, you're putting 40% down. With that amount of equity, you're going to see that hit market, as a resale, not as a foreclosure.
Correct.
And I think that's the biggest difference is the standard, the average credit score is much higher now than it was in 2008. The average equity is much higher now than it was in 2008. Like all these factors that everybody's looking back going, hey, we're going to have the same thing. And it's like, well, no, it's a much different environment today than it was. And the quality of mortgages, even in the non-QM space, is much stronger than what it was than in 2008.
Yeah, that's where I agree with you, is there's so many differences between what happened in 2008 and currently. There's also different economic factors, but the loans are a lot, like you said, the loans are a lot stronger than they used to be. Was reading last night that FHA may cut its insurance premium a little bit for buyers. because by law they're required to have like a 2% coverage, and actually they've got about an 8% reserve right now.
Yep.
What does that mean? It could be 20 anywhere. They're estimating anywhere from $20 to $50 per month savings for clients, which at this point that could help. That could really help somebody.
Yeah.
Not done yet. It's something that they are discussing.
It's government, it's HUD. They're discussing it. We know that that's going to take a minute to get passed.
Yes, exactly. So that's what we're seeing. There's a lot of articles out there about the housing market and the layoffs going on. So it's like anything. When the markets start to contract, you're going to see companies start contracting, tightening up their bottom line.
And that's the hard part, like you said, is I think everybody, like, if you're not in these industries, you're going, oh my gosh, a company's closing, or that's shutting down. That happens in every industry daily. Like, correct. It's not, but and it's like, oh, there's these layoffs and it's bad. And it's like, well, you have to take into context, like, last year was the busiest by a mile, and more loans written last year than ever before. And it's not going to be as high this year. And that's okay. Refinances aren't as part of it. But that, like, companies like ballooned because they were like, man, there's so much volume. So they doubled their staff. And now they're back to the production they were doing before 2020, 2021. And they're having to get back to that. And some companies just can't maintain that. So they're like, hey, like, we didn't set ourselves up to be able to get past this hurdle. And that's where you see like a lot of non-QM specifically. And I'm going to say this, like, even established companies, they're known to come into the market and leave the market quickly, right? When it's really good, they're there. And then the moment it's not really good, all of a sudden they're like, hey, we're not funding, we're not doing this. They'll shut down their operations. And the owners, and I'm not saying that in this situation, but a lot of these owners, they ran a company, market turned, they shut it down, they took all their millions, they waited a year or two, market readjusted.
Wait for it to come back up.
Brand new company opens up. Different LLC, same ownership. Because these guys, I mean, look, if you're running a company that's doing $1 billion+ in transactions, you're a smart person. And if it's all your risk, you're like, yo, I'll sit on the sideline for a year. I got plenty of reserves. Oh, now's a good time to come back. Here I am.
Yep, exactly. No, it makes perfect sense. And we've seen it. We've seen the cycles before, and we've seen the companies go. Like you said, you see a new company pop up and you look at the name, it's like, oh, okay. Gotcha. Know who you are. So.
Like, could even hire a new marketing team. Same.
Yeah.
Didn't even change colors. Different name, same logo.
Yep. Well, the other thing we want to go through, like we do every week, is the numbers. I think last week when we were talking, we had seen a drop in the sales, and we're kind of curious, was it because we lost a day or something like that? So let's hop in to the numbers for this week.
Okay.
And I learned something. I can blow this up so we can actually see it.
There we go.
And the big thing right off the top is, we rebounded. End of month.
Yeah.
We jumped to 767 closings last week, from the 456 the prior week. So kind of makes sense. We had lost a day plus end of month, and guess where it averages out? 600.
Yep.
Right where we've been sitting, 600. Now there's a couple interesting things that we're seeing in the charts. And I was actually just reading an article that Las Vegas, for the first time, their median prices decreased. Only $2,000, but it's the first time in 2 years they've shown a decrease. Over the past 3 weeks, we are starting to see a decrease in the median value, as well as the average value.
Yeah.
Plus, like we've been noticing, inventory's jumping up. We actually broke the 4,000 mark on inventory. So let's dive into it a little bit more. And here's where you see the sales price. Okay. So the week of June 5th was really our peak.
Yeah.
For value. And since the beginning of June, each week we are on a slow decline. This is your average price. So our average price is now just sitting over $500,000. While our median peaked the week of June 12th, the past 2 weeks, we've dropped down. We're actually below the June 5th numbers.
Mm-hmm.
So we're starting to see a slow decrease in the median price. And that could be that people aren't trying to stretch the numbers quite as much. They're getting more realistic, because we're still not seeing a big discount off of the list price.
Yeah.
The only place you are is in the high end stuff.
Mm-hmm.
I mean, they actually kind of took a beating. You see here, the average original list to sales price in over $1 million was $100,000 discount.
Mm-hmm. 100. So
So this is the one place where we're starting to see, and I think we've mentioned a couple articles where luxury market has seen an 18% decline in sales since the beginning of the year.
Mm-hmm. So I think, if we take that into consideration, right? Like you take the average is, obviously you add all the sales up and you divide by the number of sales, right?
Mm-hmm.
Do you think that average is declining because we're not seeing this $1 million+ market be as high right now?
That definitely is hurting the number.
Mm-hmm.
So it's probably making it more realistic where we're seeing the I guess the average buyer, where the average buyer is buying.
Yeah.
So that makes sense because your average and your median are all tied to the high and the lows.
Mm-hmm.
And if you've got less up here on the high end, your median's going to drop. A little bit.
And I think I look and I'm just thinking about and I for everybody tuning in or watching this in a later, like one of the questions I have is like, as this market, like we're seeing this shift, and it's not a major shift. And I say not a major, but I think it's kind of gradual. It's not like boom, shock, in your face, we're done, right?
Mm-hmm.
But what I still notice is I've talked to or ran into scenarios where we've got clients that they're in the $1 million+ price point, and they're being told they need to put cash, and we're going, wait, what? Is that still the case? Is that still like, are we still seeing really competitive in certain pockets and less in other, and is it like territorial or regional or neighborhood specific,
As they say in real estate, everything's local.
Mm-hmm.
Everything is local. And you're starting the Deltona area, for instance, where your median price is really sitting around that $300,000 mark.
Yeah.
There, the inventory is completely exploded. You're not getting the multiple offers.
Mm-hmm.
The average days on market up there, I think, has jumped to about 26 days.
Okay.
It's almost a month now.
Yeah.
Where you go down to Lake Nona, which is for the young professionals, it's much more desired.
Ultra modern living,
exactly.
VA hospital. You've got all this other stuff that's right there.
That's still getting competitive, even though you're starting to see the builder inventory shoot up down there.
Mm-hmm.
And that's one thing. I am getting inundated with builder incentives right now.
Mm-hmm.
So they're looking at it going, we've got to get the inventory that we've got.
We got to get it.
We're going to slow down, but we've got to get it off our books.
Mm-hmm.
And what some of them are offering is to lock it until the finish of the build now. So they may be looking at a November or December.
So they're doing 6, 8, 9 month locks now.
They're trying. They've also got the 2-1 buy downs incentives as well as you had mentioned.
Mm-hmm.
So that's what you're seeing is they're looking at their inventory and they're going, man, we've got to get this down, and we got to get this stuff moving, because the worst thing, again, as always, the worst thing for a builder is to be sitting on inventory.
Yep,
it costs them money every single day.
Yeah. For home buyers, like if you're looking at new build, it's really, really good to have these incentives that you have for the builders, that they're throwing different things, the 2-1 buy down, the long locks, like those are great. But my recommendation for anybody that's under contractor is when you're like 60 days out from completion, Talk to an independent mortgage company as well. Like, talk to them to make sure what you have is actually really, really good or not. Yep. Because, if rates decline, or a lot of times, I looked at a fee sheet the other day on a 2-1 buy down. I was like, hey, like, I can give you this rate, and this is cool. Like, their starting rate, because a 2-1 is basically for the first 2 years, they're buying down the rate to 2% lower, then 1% on year 2. Then it goes to their market rate for year 3 a lot of times. And what I found is like, look, like their rate, the cost for that rate, like your savings actually works out to where like year 1, you're profitable, but year 2, you're break even. And year 3, it's actually better to be in our loan.
Yep.
And it's kind of like, it sounds fancy. It gives this nice marketing number that sounds awesome.
Yep.
But the cost for it doesn't make sense.
And unfortunately, people look at payments a lot of time. They don't look at the long cost of owning a home.
Exactly.
And that's quite honest. That's what got a lot of people in trouble back in the early 2000s.
Everybody did that 10-year balloon.
Yeah, the 228. Remember the 228s?
Yep.
First 2 years, you're locked in at this rate, and then it can go up to, and guess what? It all went up to,
and it jumped, and
it jumped.
And we're seeing right now the first time in a while that those adjustable rates, that as people are hitting those reamortizations, or now the interest recalculations, it's adjusting 1.5%, 2.5%, depending on, like, most people are capping on the adjustments right now. We're going to see that for the foreseeable future.
Yeah, which makes sense, because when you look at our jump from 3 to roughly 6% in 6 months.
Yep.
So it's when you're looking at it, I think I truly believe it's important, is, I know you do it, is explain the whole cost of owning the house. Yep. Because you got to look at it, and people just get excited. Oh, wow, I can afford that. Oh, for the first year, it's only going to be $1,000. Yeah. Oh, I can afford that. Yeah, but the second year it's going up to $1,500. Third year it's going up to $2,000. Yeah. Can you afford that? And
yeah, that's the hard part. Is a lot of people. It's like car sales. I joke a lot of times. It's like they show you a number, and they're like, "Doesn't this look great?" And then you get to the finance department, and all of a sudden your payment's way higher. But you're like, "Man, you already sold on the vehicle." That's what a lot of these loans are doing. They're like, "Hey, doesn't this payment look great?" And the person is focusing on that payment today, and it's really just a temporary payment.
Yeah, it becomes emotional. And when it becomes emotional, the buyer loses.
Yeah.
The buyer will always lose when it becomes emotional. Then just real quick, here's our inventory numbers. And as you can see,
up over 100%.
This is single family homes. We're up over 100% since the beginning of the year.
Okay.
We didn't do as big a jump this week as we have the past 3 weeks, but we're still on a consistent growth pattern.
Well, do you think the last couple of weeks we saw that jump do you think it was that a little bit of that FOMO, the fear of missing out? Like, oh my gosh, I missed the curve. Like, I got to get on the market and sell now. And now people are kind of like, okay, well, I missed out, or okay, it is what it is.
I think a lot of it is the FOMO, because I have talked to a couple of sellers. I actually got a listing going live today over in a resort condominium, and she called up. She goes, "What do you think?" I said, "You peaked. You may have missed the boat. I think we're probably going to get $10,000 to $15,000 less than what the top one was." But she bought it in 2014 for $97,000.
Yeah. Can she
and
really?
The value now is $250,000.
Yeah.
And it's funny because, like, I think you mentioned about one of your clients is, I'm looking at it going, not bad, $150,000.
Yeah.
Right. She goes, "Well, I want to make sure I maximize." I'm like, you're still going to make $150,000 roughly. Take off your closing costs and stuff like that. Okay, so you're $135,000.
Yeah.
Compared to where that property had been a year and a half ago, she would have sold it for like $110,000.
And this is the part that, like, she bought it for, you said 95, right? I'm gonna do the math real quick. So the historic average is what, 3% annually, right? Like for growth. So I'm gonna do this. I live math, and if I can open a calculator, right? 95 times.
Come on, Joe. You can do it. You can do it.
So she should have been around 117,000 if she had.
Yeah.
If she had her normal growth.
Yep.
Like that's the crazy part. Like we're upset. Like the market exploded and the average annual growth has exploded, and it's still like the part that I've been talking to a lot of clients is like, yeah, it's not going to be the 15% you saw last year, but we're still
growing. We're still, it's just back, like we've mentioned, it's back to a normal market.
Yep.
It's pulling back to a normal market. We're just so used to going 150 miles an hour that we just feel like we're crawling. Yep. And we got to get used to it, and we got to get back again to setting that level of expectation with our clients. And hey, it's all right. You're still going to do okay. Mm-hmm. I was reading an article this morning when I got up about what some of the sellers are doing, and this might be why it's hopping up a little bit too. Is some sellers are going to sell their home, rent, and wait for the market to pull back a little bit. Which is risky.
It's risky,
but I can also kind of understand it because our inventory is still limited. 4,000 is still a little bit limited.
And I know it sounds crazy and it is risky, but I'm always like, man, 100. When you rent, it's 100% interest. Like you're not. And I'm like, and you see buyers are like, and I talked to somebody the other day that a friend of mine, he's like thinking the same thing. And I'm like, you're going to sell for 600,000, then you're going to rent. And I was like, what price point are you looking to rent? And he's looking at like 3,500 a month. And I'm sitting here going, why not buy and pay 2,500 a month or $2,800 a month and use that equity and I was showing him all these different things. And I was like, and he's like, yeah, but the market's going to pull back. And I was like, okay, so what does it pull back? It pulls back 5%. All right, great. But you just spent 6% in rent for the year to save 5% on the purchase price.
5% on the purchase price.
So you still lost.
Mm-hmm.
I think there's a lot of population that thinks this isn't going to pull. They think they're going to see a pullback of 20-30%. Mm-hmm. And I don't think we are. And the reason being is we still have a shortage of homes nationally. We still have a shortage of homes, not just inventory on the market, but an actual shortage of homes that need to be built.
Yep. There's so many dynamics to the housing market. I think that's one reason why we both enjoy it so much. Because you sit there and you want to think you've got it, and then somebody throws you a curveball, and you're like, where the heck did that come from? Did not see that one coming. Mm-hmm. Holy cow. So the news over the next couple of weeks we got coming out is GDP. The Atlanta Fed kind of warned that it's going to be negative. Consumer price index comes out, I think, next week, CPI.
Yeah.
So we'll see if that starts pulling back. Mm-hmm. And then Powell mentioned yesterday in the Fed minutes meeting that we are looking at another increase here at their meeting at the end of July. Yep. And the way it sounded, I think we're probably going to see another 0.75 of a point increase.
Yeah, I felt the same way. It was really interesting to see how the markets reacted on my side because right as that meeting happened, boom, we had been seeing rates consistently improve. And I warned everybody that I could talk to on my side. I'm like, look, Fed's meeting, Powell's going to say something. Expect us to see some market worsening. And sure enough, we did.
Sure enough.
And it's because I think a lot of us thought, hey, maybe we see a little bit of maybe we see 0.5%. But I think, like you said, the way he implied, I feel like it's going to be another 0.75%.
Yeah. I think there's an outside chance he goes 1. I really do. I think they're so scared with this inflation.
So I know that we're running up against the clock, but I have to ask, and I'm like, I almost feel, and this might sound crazy, I almost feel like they're pulling back and a lot. They're increasing the Fed rate. They're doing this. They're selling the bond. They're getting all these books so that they can redo it. Like I almost feel like they're saying, hey, like we're going to be aggressive right now, and then we're going to come back in to the marketplace and redo it, but not as aggressive as we did before.
Yes.
But we're gonna cool it back off. We're gonna bring those rates, and we're gonna be the heroes in 2023. But we're gonna take a beating in 2022.
Yeah, they want that soft landing, and I don't see a way to have a soft landing. I think if he does a 3/4, that puts him up to what, 2.25.
Yeah,
I think they're stuck there.
Yeah,
I think they're stuck there because I think at that point, when you look back in even 2000, I think it was 2018, they got up to like 2.25, 2.5, somewhere in that ballpark. And the economy just went big time. So it's like, And then you kind of look at what the EU and Japan is doing right now.
Yeah.
Japan's a mess. I thought the EU was bad. Japan's a bigger mess. I mean, their currency is just total collapse.
Yeah.
The EU has started buying back bonds again. So they're doing basically it's quantitative easing.
Yep, they're quantitative
easing. They started quantitative easing. And if you look at what the dollar's done, oh my gosh. The Dixie, which is of course the puts the dollar against other currencies.
Yep.
We've gone from, I think in January, 97, which is basically very low.
Yep.
To almost an all-time high at 106 right now.
Ooh,
so against the euro, against everything else, we are just crushing it.
Yeah,
I mean, it's gotten extremely strong.
It's going to be like you said, like we're seeing this, and we look at, and I think we talk about all the craziness that's happening here in the U.S., but there is a lot of craziness and turmoil happening around the entire world.
It's the whole globe.
And it's not just, a lot of it's economic based. It's a lot of this, but then it's like you look at what's happening with the British Parliament and government, that just like bombshell news just popped out today and yesterday of everything.
Yep.
With, and we won't dive into that, but those things, I think he resigned today.
Yep.
But I think, you look at those pieces and those have, right now it's the shock of like this happening, but they have they have impacts that are going to come down to the economy in those regions.
One of the biggest ones that I've seen that I just not a lot of news coverage is Holland. All the farmers are shut down.
Really?
All of them have shut down. Holland is the second biggest exporter of agriculture next to the United States. And their government has come out with new nitrogen restrictions that are basically, you've got to cut it, max is like 90%.
Yeah.
And all the farmers are sitting on the sidelines. They're like, we can't do it. We can't do it and produce food.
Mm-hmm.
And it's gotten into just,
I mean, just a quick Holland farmer strike, article, police fire on Dutch farmers, Dutch government against Canadian style crackdown, Dutch farmers protest against government plans. Like
the farmers bought themselves a tank yesterday.
But you go into that and it's like, okay, well, what's that impact? We don't feel that impact today.
No.
We feel that impact when their crop that was supposed to be harvested isn't as plentiful and that export doesn't go out. Like that's when we feel the impact.
That's when we feel the pain. Yep. So you've got Ukraine who's not exporting all that.
Who's not? Yep.
Then you've got Holland who's not going to be exporting their stuff. And boy,
you've got, it's very interesting times. We're going to see economies react, and we're going to see a lot of expansion. And here's the crazy part. I know this sounds crazy, but man, like I kind of just feel like in all of this and the world powers and the world economies and all the chaos and craziness of America and USA, we're going to come out on top.
Yeah.
Like everything else is pointing the picture that's like, even in this craziness, other countries may laugh at us, but we still find a way to come out on top.
To come up smelling like a rose. I hope so. I pray. Yeah. So,
awesome.
Well, sir, great morning. Glad you could make it.
Yay. There you go. Absolutely.
At least I'm glad it wasn't you in the accident. So
yes.
Take care. We will see you again next week.
Sounds good,
Everyone,
man.
thank you so much.
Rock it out, guys.
Bye-bye.